Whether you're a seasoned investor or just getting started, understanding capital gains is essential for maximizing your profits and minimizing your tax liability. In this video, we will discuss different types of capital gains, how capital gain is contributing to total tax payable, and methods to legally and ethically reduce your capital gains taxes. My name is Gregory Rosdiba, the founder and CEO at Dundas Life, a digital insurance brokerage in Canada. We guide thousands of Canadians through the complex world of investing and insurance and help them build a better financial future. If that sounds like something interesting to you, reach out to us by clicking the link in the description below. And don't forget to subscribe to our channel. Now, what exactly are capital gains? In simple terms, it's the profit you make when you sell an asset such as stocks, real estate, or even collectibles, for more than what you initially paid for it. While it sounds exciting, it can come with a tax bill. First, I will introduce you to two acronyms often used by accountants, ACB and FMV. ACB, which stands for Adjusted Cost Base, is the price you pay for an asset. FMV stands for Fair Market Value, which is the price at which you sold it. Capital gains are simply the fair market value minus the adjusted cost base. In Canada, we have a 50% inclusion rate, which means that 50% of the capital gain will be added to your income. As a result, the higher your income, the higher your capital gains tax rate. Now, there are two types of capital gains, realized and unrealized. Realized capital gains are when you have already sold an asset at a higher price, and unrealized capital gains are the potential capital gains from an asset that you have not yet sold. Suppose you're a resident in Ontario earning $80,000 a year. According to federal and provincial rates, you have a marginal tax rate of 29.5%, which means that the next dollar you make will be taxed at 29.5%. Let's say you bought Apple for $5,000 and later sell it for $15,000. The result is a capital gain of $10,000. With a 50% inclusion rate in Canada, half of the capital gain, which is $5,000, will be added to your income, resulting in roughly an additional $1,525 in taxes owed. Now that you understand how capital gains taxes are calculated, I will introduce you to three ways to reduce your capital gains tax. The first method is by claiming a capital loss, which is similar to a capital gain but happens when your selling price is lower than your purchase price. A capital loss can be carried back 3 years and forward indefinitely. This means this year's capital loss can be used to offset capital gains up to 3 years into the past. It can also offset income into the future, but the process is a bit more complicated. For example, if you had a large capital gain 2 years ago, you can use the capital loss this year, and if you had continued to lose money for the next 4 years, you can keep carrying it until you have a capital gain. But be careful, there's a special case called superficial loss, which is a type of capital loss that cannot be used to offset capital gains. And it happens when you immediately buy shares after declaring capital loss. The second one is good timing. Taxes are due on April 30th every year in Canada. Make sure you sell shares early so you have the funds available to pay your tax bill. For example, sell in December rather than in February. The third one is contributing to an RRSP. With an RRSP, your capital gains are tax deferred. So essentially, you don't pay tax on your earnings until you start taking the money out in retirement. At that point, you may have a lower tax bracket and any capital gains will be counted as taxable income. So there you have it. Now you should have a good understanding of how capital gains work and how to reduce your capital gains taxes. If you have any questions or need assistance with investing, segregated funds, or insurance, feel free to reach out to a Dundas Life advisor today. Simply click the link in the description to book a call. And if you like this video and want to learn more relating to this topic, please subscribe to our channel. Stay informed and stay financially secure. Until next time.